Zoom at 8, welcome. We are about to hear from Justin Sadler. I tell you, I've been searching for a CPA. My CPA died. I was the last person that he finished my taxes. I don't know if that's an indication of what's up ahead, but in this community, we are lacking CPA strategists, people that will give us direction. You know, the syndication model, we've got tax advantages. We've got a lot of people coming in as GPs, as LPs. We've got real estate professionals. We've got people with 1099, W-2. We've got 1031. How many more numbers do we need to try and figure out how our CPA can figure out our taxes? So I reached out to Justin Sadler probably 2 or 3 months ago because I am in a bind. I need a strategy for my LP, my GP, my W-2, my husband's W-2, my 1099. All of that is so complicated. And so I found Justin, and he's in the Dallas area, and I want to share him with you because I get so many questions. Who can help me do my taxes? So Justin Sadler was born and raised outside of Fort Worth, Texas, where he lives and works today. He graduated from Oklahoma Christian University with a BA in accounting and immediately went to work for a large firm in Dallas. After 6 months of grunt work as a tax department low man on the totem pole, Justin accepted a job at a small firm where he was taught a full gamut of services that the small business needs to be successful. So for 6 years, he trained under several very skilled CPAs and became licensed himself. Now, 11 years later, Justin has been blessed with an incredible team and many clients that enjoy working with him and for him. And he loves to problem solve. Beyond just getting to know people, meeting them and spending time with them, Justin consults on business issues. He is a finance guy and shows clients the good side of taxes. Is there anything such of good side of taxes? I'm hoping to hear it. He loves the satisfaction of breaking down a complex subject and empowering clients with the knowledge to make great business decisions, big or small. So, Justin, welcome to Zoom at 8. We have been here for 2.5 years and you haven't been with us, and we are so excited that you're here tonight. We want to hear things like real estate professional, LLCs, cost segregation, trusts, recapturing income, 1031, and maybe there might be some questions in 35 minutes after you cover it all. You're kind of like the Wizard of Oz. Welcome to Zoom at 8. Justin, how are you tonight?
I'm great, Julie. How are you?
I'm good, thank you. Before we get started, if everybody would give Justin all the respect and direction that he deserves, go up to the right-hand side, press the view, bring it to speaker, and there he is. I'm there probably because I'm talking, but Justin's going to be there here shortly. So Justin, thanks again. Really appreciate you coming. And we are anxious and wanting to know more about taxes, and it's right around the corner. What can we be doing today in multifamily, in structuring our deals and structuring our taxes to get the best benefit? Give us some ideas.
Well, there's really no good news. You're all screwed. Good night.
All right. Well, on that note, good night. No.
I was going to make this short and sweet. No, the good news is, depending on your specific situation, a syndication or other real estate investment opens up a ton of opportunities for you. One of the things I told Julie when we first met, and it's very true, is the person who works a W-2 job, has a house and a couple of kids, and goes home and mows the lawn and has a whiskey before bed in the evening, and just that's their whole life, doesn't allow themselves much opportunities in the tax law to find advantages on opening up how to use their investments to save them taxes in the current year and going forward. And so real estate investment has become hugely popular in the last couple of years, and especially with the beauty of the syndication is you don't have to be the person to come up with $1 million worth of capital to buy a property all on your own. That a collection of folks can put money together, they share in the tax benefits, and we can kind of talk about the pros and cons of the different levels as we get into it. But the good part is you're putting your money, instead of parking it in a 401k and putting it in the market and sitting back and waiting, you're putting it in an opportunity that you can get tax advantage out of today. So I'll go through a little bit of the different complexities to it, the pros and cons. Hopefully you find yourself in some of our examples, and if you don't, I'm happy to answer any questions you have.
Perfect. All right. So are you going to take it, or do you want me to interview you and ask every question under the sun?
Well, let me start with the basics that we kind of work through. So the first thing I advise any client who's getting into real estate investment is to get themselves a good attorney. Tax is part of your picture, but by having a relationship with an attorney that you trust, there is a large portion of this that involves legal liability, that you'll want to know your personal assets are secured if something goes wrong in the deal you're investing in. So get an attorney that you know and trust and can help you with entity creation, that can read documents for you. And in particular, if you're thinking of taking on the GP role in a syndication, have an attorney that will advise you through that entire process. The GP role in your syndication should be held in an LLC to provide some legal separation for you, because the general partner in these syndication partnerships is on the hook for everything. That's the person who's assuming liability if things go wrong. Now, the plus side of that is that's the person who gets the most tax benefit the earliest as well. So there's benefit to you in the current year for being a GP, but that comes with a legal liability that you should know that you're protected if the deal goes bad. As a limited partner, those roles kind of flip. You trade a lack of legal liability for a little less control over what you can take advantage of this year on your tax return. So the primary thing to remember is the GP is someone who we really want to review every contract, have a good attorney contact, know what we're doing, and have that role is very well protected before we enter a deal.
So I'm going to ask you a question.
Yeah, sure.
Let's talk about LLCs.
Okay.
We've got Wyoming, we have Nevada, we've got Texas, we got California.
Yeah.
Tell us the breakdown of those and what is important, choosing the right one.
Well,
beyond what our lender asks for.
Yeah. The state in which you form an LLC, the legal differences between the states is what you'll want to understand. There's not specific tax benefits necessarily to having an LLC in a state in which you don't live. So there's still the chance that if you live in California and you have a Nevada LLC and your deal is based in Texas, you may still run afoul of California taxes. You may have a Texas tax liability. You may have a Nevada tax liability. So if you're going to form an LLC outside of your state or outside of the state in which the deal is being done, you need to understand the legal and tax implications of that particular state and make sure that you're current on your filings. The beauty of an LLC in any state is that they're cheap, they are flexible from a tax perspective, and they provide a legal separation between your personal and business assets. But an LLC is like a fence between your house and your neighbors. And if you don't make sure that every single post is securely in the ground, the fence can easily be blown down. And that's what you don't want to have happen. So making sure that you're up on your tax requirements in any state in which you're registered or in any state in which you're deriving income is key to making sure that your fence stays strong and that your legal liability protects you if something goes bad.
All right. How do I get that information? Call you?
LLC entity formations usually require an attorney. And like I said, especially if you're going to hold a GP investment in a partnership inside an LLC that you're forming, you need to have an attorney form that entity for you and review your contract to be the GP in that deal. From a tax perspective, the vast majority of you, if you're creating an LLC for federal or state tax, those LLCs will probably file as a part of your personal tax return. They're what's called a federally disregarded entity, meaning the IRS doesn't care that this investment is held in an LLC. It doesn't file a separate tax return. All income and expenses are passed through to your personal tax return, just as if you owned the investment under your personal name. So for the most part, in most of these deals, your LLC is purely legal protection. So all the investment you'd want to put in as far as time and attention and finances to securing an LLC and making sure that it's right and it's well maintained is primarily the legal side.
Let's continue to talk about LLCs because we have one for GP and we have one for being an LP. Can you talk about active and passive on the tax implications or advantages?
Sure. So active income is any income derived from your personal time, attention, and expertise. Time is your primary trigger. So in order to be considered active in any investment or business, you would need to be able to show that you commit a considerable amount of time during a year to actively managing a business or actively managing an investment. This is a place where a lot of folks who are investors run afoul of the tax code. The IRS's goal is to make you passive in every investment you're in, because then you're limited in your deductions. So like, for instance, Mark was mentioning a cost segregation study. An investment that has huge losses in the first couple of years because we've done a cost segregation study and we've accelerated our depreciation is fantastic if we can claim active status in that investment. If we're passive in that investment, there's a chance that our deductions are limited and carried forward into the future, which is fine. You don't lose them, but you might be counting on, I put $50,000 into this investment. I've got a $60,000 loss coming to me. I can get a $50,000, $60,000 deduction on my tax return this year. And that may not be the case. You may be passive in that investment, meaning that loss is limited to $25,000 or worse, zero in the current year, and that entire loss is suspended and carried forward. And then the giant deduction you were counting on this year won't be able to be used until that investment generates income for you in the future.
That is huge. I don't think that we do a very good job of explaining that.
Yep.
So I want everybody to hear that actively on the GP side is when you get to take advantage of the cost segregation. Am I right, Justin?
That's right. So a general partner in a partnership or in a syndication is considered active by default. And that status is granted to them by nature of their liability in that particular business. And so they're considered being the person on the hook gets the tax benefit of being treated as active. If you're a passive investor, is someone who puts $50,000 into a deal, they get a limited partner status. They go back to work and work their 40-hour-a-week job, and the investment is what it is. You have no say-so. You don't have voting rights. You don't have any control over what money is spent or how the deal is operated. You are considered passive by default. And that means that your losses may be limited on your tax return and carried forward into the future.
That is another very important piece here, because we have lots of income coming in, we being all of us who are working W-2 jobs, who want to place capital, and we're told that cost segregation, as mentioned, Justin says that 50 or 100,000 that you're putting in, it gets put on the shelf, right, on a cost segregation. So it doesn't, you're not going to see it in the tax year until, when do you get to take that, Justin?
So depending on your income in other places, that loss is more than likely waiting to be used against future income from that exact investment or something similar to it. Or sometimes I have clients who have losses carried forward all the way through the life of an investment. And if a property liquidates 5 or 6 or 10 years in, they don't get those losses until that property is sold. So you have to really know your current situation and what type of partner you are, what kind of losses you're expecting, to know what you can plan on deducting throughout the life of the investment, and not planning on a huge loss that may get suspended until the property sells. Okay.
We've got a lot of capital raisers in our community. Capital raisers have a job based on our conversations with the SEC. We all have to have a job. So they will receive, based on their job and how much money they bring in, they're going to get some GP status. They're going to be doing a job. Do they get to take advantage of this active position, even though they necessarily haven't brought in the capital? They brought in other people's capital. How does that work for them?
I keep feeling every answer needs to start with, it's highly dependent on your specific situation. Consult your own tax advisor for specific advice. However, if we can just apply that blanket statement to everything I have said and will say going forward. So the answer is, as a partner in this partnership, the general partner does get to benefit from active status. However, it may depend on the general partner's actual partnership percentage in this deal as to how much you get to benefit. So in an example with numbers, I put 50,000 into a deal. I bring the other capital to the deal, and I take on the role as the general partner. In the first year, we go to Mark, we get a cost seg study. We're able to take a $500,000 loss in total on the partnership. That's what we lost that year, revenues minus expenses. Well, if my ownership percentage is 1% in that deal as the general partner, my loss for that year is $5,000. And that's all I'll get to deduct. Even though I have active status, even though I put 50 grand into the deal, I'm limited to my partnership percentage and what of that loss gets allocated to me specifically. So it's dependent on your role in the deal. It's dependent on your percentage in the deal. And then you have to show that you have a capital investment greater than what you're trying to take in loss to be able to deduct that. If my portion of that loss were $60,000, but I only put 50 into the deal, I may be limited to deducting just that 50, and the rest gets carried forward into the future. So when I say it's specific to your situation, that's what I mean. There are many elements that factor into that you need to understand on the front end. It doesn't make it into a bad deal. You just need to go into it clear-eyed and understand the current tax implications for you by taking on a specific role.
Exactly. Now, I got another layer of this. GP status, I put in 50,000. I use my LLC for my active, right? My LLC that's active for my active, but I'm putting in 50,000 into the limited partnership. How does that how does that work?
Well, we would want the LLC to be the general partner.
Gotcha on that.
So Julie puts 50,000 into an LLC, and that LLC contributes 50,000 into a partnership as the general partner. So all this LLC does is it holds cash temporarily, and then it holds your investment in this deal, right?
So do I only get GP shares on that capital, or can I do a little bit in the GP and a little bit in the LP?
You absolutely.
And do I invest the capital coming out of that bucket from that LLC that's for passive LLC? Is that right?
That's right. And so what in your scenario, you end up with multiple buckets that are treated differently
for the same deal.
Right? And it works out to be like if you go to the yogurt shop where you put the yogurt in and then it has those tall things of candy where you pull a lever and the candy comes out and drops on top of your yogurt. Well, you might have 50 different silos of how your particular investment in this particular thing works out for you. You can have a myriad of them. And depending on how they all work together and what tax laws you can take advantage of in your situation, you may be able to pull 10 of those levers and get the benefit of 10 of those right now. You may only be able to pull one and get that. And some of them get suspended, but they're each treated individually unless you may qualify for specific laws that allow you to lump everything together, put everything in one big tube, and then GP benefits from LP and et cetera. It can get extremely, extremely complicated. But the point is, what I advise clients is make your investment based on what you believe is the right financial move for you, and work with a CPA to understand the tax pros and cons of that to make sure it's still the right financial investment for you.
So let me make sure I understand. I'm a GP. I want to put money into the deal. It would be in the active, using that active LLC.
Right.
Would I ever be putting it into the using that same LLC as an LP?
Probably not.
Okay.
Okay. So the point of the LLC, again, is legal protection. It's not giving you specific tax benefits in most situations. So if my legal exposure is high in a GP and low as an LP, the last thing I want to do is jeopardize a low risk investment by pairing it with a high risk investment inside the same entity. So the point of having an LLC is to provide this separation between your personal life and the GP, which has the highest risk. And then you can have a separate LLC that holds many, many limited partnership investments because they're very, very low risk. So in market terms, it's the equivalent of holding Bitcoin in an entity separate from yourself, and municipal bonds in a separate account, so that if one goes bad, it doesn't pull everything down with it.
Makes sense. Makes sense. Okay. Let's talk about real estate professional.
So real estate professional is someone who is actively involved in the business of real estate. There are qualifications for what that looks like. If you meet those tests, it allows you special access to the losses that a limited partnership investment to someone else may be suspended. So I'm a CPA. It's hard for me to argue that I spend a considerable amount of my time being a professional in real estate. So if I'm invested in a limited partnership with Julie, Julie is a real estate professional. She'll have access to losses that I don't, because she qualifies to be a professional in this business, and this investment is related to her specialty. So a real estate professional becomes a hybrid between active and passive status, where you can be actively involved in one kind of real estate. And as long as you meet the test to be a real estate professional, it allows you access as if you were a general partner to any other type of real estate investment.
So if you were W-2 and you have passive investments, you went and switched it to the real estate professional, can you then take those losses that they were on the shelf, can you take them day one, or how does that work?
It's complicated.
Okay, makes sense.
But in short, you have availability to accelerate losses and to take losses that a typical limited partner who doesn't qualify for real estate professional status, they won't be able to do the same for themselves. So this is also a caution. If you hear someone say, well, my CPA lets me deduct everything, or my CPA lets me write off X, Y, and Z. Well, you're never comparing apples to oranges, because you don't know what their specific qualifications are. If one of you qualifies for a real estate professional and one of you doesn't, the real estate professional may get to write off stuff that the other person just has to hang on to for years and years and years, because they've got special access to some of these losses by nature of it being within their expertise.
Makes sense. So in my case, I'm married to a W-2 earner. We live in a community property state. Do I get only half of his or mine? How does that work?
It depends on how you set up the investment. So if you are married to someone who has a regular job, who would not meet the real estate professional test, and you do meet the test yourself, it's my suggestion that you form an LLC that is solely in your name, hold an investment that is in an LLC that is 100% in your name, and then all of the income flows down to the person for whom we have this designation special status. In a scenario where we have where we form an LLC, and I say, well, I share everything with my wife, I live in a community property state as well, I'm going to make her 50-50 in this LLC. Mm-hmm. It changes nothing about our tax status, but it may introduce half of those losses being suspended because she doesn't qualify for real estate professional status and I do.
That is huge.
So you want to be very careful and know that I have a lot of clients who, for instance, the husband is a pilot or a banker. Their wife has been at home for a decade. The kids are older. She wants something to do now to get out of the house and get away from the kids. She's going to go get her real estate license, which is fantastic for us because they've been holding rental property or they've been holding other real estate investments that have had these suspended losses for years, and we can't do anything because he's got 200,000, 400,000 on a W-2. We're just locked in. Mm-hmm. Well, if we isolate these investments to flow to her now as a real estate professional, she unlocks these losses that it doesn't matter what he's earning. She gets advantages of these losses because of her expertise and her tax qualification. So you want to think clearly about who is going to qualify. And most importantly, if you have to defend this sitting across from an IRS agent, how are you going to explain that you qualify for these losses and that you meet these tests?
Fantastic. So in that case, you would want her to have an LLC just for herself. Oh my God, that is so huge. Great, great information.
And that, now let me say, that applies mostly to the limited partnership investments. Again, because as Julie's example, the limited partnership investments are the ones where we end up with those losses put on a shelf. We have no control over them. A general partnership investment, we're probably getting those losses regularly. So we're not as concerned about that side. It's the limited partnership side where we get those suspended losses. That's where we want to try to take advantage of a real estate professional designation.
Nice. Excellent. All right. That was great. LLC, real estate professional, cost segregation. Let's talk about recapturing this income when it sells. Nobody talks about it. I want to hear your thoughts on this because it can be dangerous. Like, you got to figure this out. When do you do that?
The tough part about being a limited partner in these investments is you don't have control. You don't have control of what deductions you get when. You don't have control over when a property might sell and what type of gains you might see because of that sale.
But we don't have toilets and trash and tenants, so we like that.
That's right. That's right.
So sell us on that. We're selling that idea, but keep going.
So when a property liquidates, most of the time a limited partner will see a capital gain. They'll see some of that gain allocated to depreciation recapture, which means we're not getting the benefit of capital gains rates. However, they may also have giant suspended losses that have rolled forward from the years that they weren't able to deduct, that all now come flooding back to them at once. So there's a give and take of these things. And again, in your specific situation, if you have an investment that is consistently losing, you want to know what the plan is around that and have an idea of, if this property sells, here would be my rough cut of the gains. A CPA may be able to tell you what you might expect as far as a recapture gain, what the income tax impact would be to that. And they can also tell you what to expect as far as passive loss rollovers that could come back to you all in 1 year that would help offset that income tax event also. But it's a little like being invested in a mutual fund where the fund advisor turns over the fund and you don't have any control. You see tax from it no matter what. Instead of $1,000 invested in a mutual fund, we're talking about $50,000, $100,000 invested in a real estate property. Makes
sense. That's from the LP side. Let's talk about GP side. How does that get affected by a recapturization or recapturing of the income?
The GP side is very similar. The only difference is a GP is more likely to have deducted the bulk of their losses over the life of the investment and may not have a big passive loss bubble that will help in the event of a capital gain or sale liquidation of a property. So from from a GP perspective, you really got to be on top of your numbers, really watching what comes through, and you got to know. Fortunately, you have a little bit more insight as a GP to know if this property liquidates at this price. Here's what I've got. I'll get to recoup my investment if there's any basis left over, but the rest may be capital gains, and I may be in for an income tax impact. For the most part, that's not a bad deal. Capital gains rates on average are still lower than typical income tax rates, and so in those scenarios, there's still a good chance that a big bulk of your payout is at the lowest possible tax rate. The most important thing is that you know what numbers may be coming down, and you've got a CPA which you can communicate and say, hey, this property is going to liquidate for this. And especially if you know that property sells in March, you need to be with your CPA at the time and know how much this is going to cost me, prepare for it now, maybe even pay now. I know we hate the idea of just going ahead and paying taxes when no one asks us to, but it could save you longer in the long run by being more on top of it as soon as you know.
Amazing. Now, my question to you is, we get these large gains. Would it make sense to do a 1031 out of a syndication? How do you manage your money at that point?
Okay, I want to start this one by saying 1031 exchanges from a standpoint of tax law are very tenuous. This is a strategy that people have used and used extremely effectively. However, for the novice, you need to understand that currently that law has been explicitly under attack for the last year or so, and could very well go away soon. It's seen as a tool of the wealthy, and could be vulnerable. Secondary to that is a 1031 exchange is not tax elimination, it's tax deferral. So even in the scenario where you can turn a gain into a new investment, all you're really doing is rolling that gain into a new investment, where then if you sell that, you have a tax event on both of your investments. And you could have an extremely large tax event.
So we go as a group and maybe even into a fund, right? And you invest in a deal. We're coming up to selling it. That syndicator can bring you to the next deal, but you would still need to pay your capital gains and getting into the next transaction. Yes or no?
No.
Okay.
If in the scenario, the ideal scenario is all partners agree, we're going to sell this property, we're going to work with a 1031 exchange company where the profits go in, or the net proceeds go into an escrow account to be held and invested into a new property once one can be found. Okay. There are 1031 exchanges where you could do that just with your investment in a syndication. However, let's just use the broad example of we all as partners agree we're going to sell this property. We're going to use every penny that we make and roll it into a new one.
With the limited partners as well.
Right. Everything legally stays the same. All the partners stay the same. All of our money stays in there. All we're saying is we're going to take this property, we're going to sell it, we're going to use those proceeds to buy this property. Mm-hmm. In that scenario, the partnership, the collective as a whole has a gain. Typically, that gain would be split out amongst your partnership percentages, and you would pay personal income tax on your portion. However, if we all agree we're going to roll this gain and all these proceeds into a new property, then that gain goes into the new property's investment and reduces our tax-free basis in that property, so that if then 6 months down the road we say we're selling this property and we're cashing out, now we're paying gains on whatever we incurred in both investments. Right. So the gain is deferred into the new property. It is not eliminated.
Right. Okay, makes sense, makes sense. Oh my gosh, we have really covered so much, and you've been so generous with taking all of my direction on this. I think it would be good if we opened this up to everybody here, because I would think that there might be some questions or needing of clarification. So if you have a question, please raise your hand and come to the front of the gallery. And yes, Ruben.
So I actually heard today from Logan Freeman, who is a broker and a syndicator out of Kansas City, and he gets a lot of his deals that he sells, his commercial real estate deals, to 1031 guys. He told me today, actually on a podcast, that the 1031s are not going to be going away, that they canceled that. So that was number one. And number two, in a syndication to 1031, you can't be an LP in that syndication, as far as I know. So maybe you can clarify a little bit, because I thought in order to 1031, you had to be on the title of the commercial property or other kind of property, so that way you can actually then transfer your ownership into, tax deferred into another deal, but not necessarily as an LP, only as a owner of the actual property. Is this correct? Tell me more from your perspective.
Okay, so part one. Yes, there is good information for us to believe that 1031 exchanges will survive this current bill that's going through Congress. However, two caveats to that. First of all, we don't know what final tax provisions go into a bill until the bill is completely written, right? So I just want to caution that. Secondly, anytime a revenue procedure, a specific tax code reference is referenced by members of Congress as something that they intend to strike, it is close to death's door, right? If they're willing to come out and explain 1031 exchanges to Joe Q voter and a reason why they want to kill it, it means it's on enough people's priority list that they've got it in their sights and they could kill it at any first opportunity. So the point of 1031 exchanges is, if we really want to roll these gains forward, the ultimate goal is rolling our gains forward all the way until we pass away and we give our assets to our heirs. They get a step up in basis, which they've also discussed killing, that part of the tax code, and it eliminates all those gains completely. So the only reason to do a 1031, or the way to do it perfectly, is you roll forward forever, you die, you give that investment to your beneficiaries, they get a step up in basis, now that gain is completely eliminated. So it's a tax strategy that works, but it's also on the radar. So don't count on something being there 20 years from now if you're going to rely on it now. That's my point there. Secondly, yes, as a limited partner, you don't have as much control over what happens to that particular investment. You don't have a voice in what's going on. But what you could have is a limited partnership through which you've invested as an LLC. And you can do a 1031 exchange of an LLC that holds an asset.
So the entire group of LPs would have to do so?
No, not necessarily. You could take your limited partner investment and you could do a 1031 exchange of the LLC that owns that investment into a new investment and roll your gain forward that way. And then whoever is buying your investment, they become the owner of that LLC, which now owns your limited partnership investment in that particular property. Does that make sense?
Yeah, there's a big caveat there that the transfership of ownership has to take place in order to happen.
Well, you have to sell it to somebody to get a gain to roll it into a new property, right? A 1031 exchange is just a defer of gain on a sale. If you find someone who wants to buy your limited property investment, a limited partnership investment in this particular property, you can sell it to them, incur a gain, sell them your LLC, and roll that gain forward into another investment in the future. That makes it so a 1031 exchange, you do not necessarily have to sell the property itself. You could sell an LLC that owns a piece of a property.
Interesting. Cool, man. Thanks.
All right, Chris, I think you had your hands up.
No, I was giving you thumbs up
Oh,
for
thumbs up.
asking about depreciation recapture, because that is something that's not talked about a lot in our space.
Yeah. I think it's great. Thank you for acknowledging that.
Yeah, thank you for asking.
Who else? Yeah, who else has a question? Moses.
Hey, Joe. Justin, just wanted to confirm, because this is something when I teach the youths, it always comes up, and I've heard a different opinion from several. So you basically said if you qualify by the Internal Revenue Code guidelines as a real estate professional, regardless that you're not active in the role as an LP, you can qualify to actually take the depreciation losses on your income. And obviously, if you have a W-2 spouse, then you split it based on the 50-50 is
Right.
truly. So that is correct, where you can qualify as an LP to depreciate, but you must meet the real estate professional status.
That's right. And the theory behind the law is real estate by nature is a passive investment. So whether you own commercial or residential property, you own it outright, or you own a limited partnership investment in a real estate entity, those are all passive investments. But if they're all real estate related and I have a real estate expertise, then I can derive more benefit from those losses than just a typical limited partner investor with no professional expertise could.
Gotcha. Thank you.
That is huge. Thank you. That was a great question. Who else has a question? Anybody else? No? Great, great.
Question.
Yes, Franklin.
Yeah, my camera's acting up again. But so as a limited partner, in terms of kind of deductions or claiming things as losses, for example, I attended a very good Old Capital conference in September. So for that conference fee and anything associated with that, is that something that I can call a loss and maybe just consider a passive loss, or is that a active loss? Is it something I can deduct against my W-2? Like, how does that work?
For you to have expenses, you need to have income. So, the fee to get into a conference, even one as great as Old Capital's, would require some sort of income to offset that. The issue of being a limited partner investor is you don't have control over the revenue and expense portion. You just get your net result. Right now, if you get your real estate license and you do one deal a year and you take one commission, now you open up an opportunity to do all kinds of additional expenses to offset that income, but it's essentially related to that earning that revenue, right? So I feel like now I'm not getting to what you're actually asking.
No, I think you're answering it. I guess the part of the question then is, can I carry that quote unquote loss forward then? So I'm a limited partner, maybe it's selling in 3 years. I go to Old Capital, conference 3 years, it cost me $1,000 total.
Oh,
And I
okay.
then deduct that.
No, the real estate professional test, I don't know the number offhand. It may be 750 hours a year.
It is.
Something similar to that. In order to qualify, you'd have to justify a professional active role in some sort of real estate profession that you commit 750 hours a year to in order to meet that test. So that's why I say get your real estate license, sign up with a broker, show properties, have signs, have business cards. even if you don't meet 750 hours, if you show up in my office with an IRS auditor and you have business cards and they drive down the street and they see signs with your name on them or whatever, like I'm actively involved in trying to get into the business of real estate. Right now, I've got a regular job because I got to pay the bills, but I'm moving in this direction. This is what I want to do with my life. That at least shows intention to be actively involved in the business of real estate on a primary level. That makes sense?
Got it.
All right, one more. If we've got one more, I'd love to hear from you. Otherwise, we need to know, Justin, I put your contact information in the chat box. Ruben wants to sign you up for a calendar event. Do you have something whereby he can get on your calendar or you get on his calendar?
Yeah, reach out. I made the smartest decision in my life was letting my assistant take over my calendar 2 years ago, and now I don't miss my own meetings anymore. And so she keeps all of that stuff, but reach out to me. I'll put you in contact and we'll get stuff scheduled.
And just for the viewers that watch this after who don't have access to the chat box, how do we get a hold of you, Justin?
SadlerAccounting.com or Sadler.cpa is my website. It's got all my contact information. You can learn a little bit more about me and my team. But really, reach out. If I can do anything to help, I'm happy to.
Thank you so much. Well, I appreciate everything that you've done for us. We have a whole gamut of investors between brand new and really very knowledgeable and educated. So it's always great to have, review. Jim, do you have a question?
Sure. Thanks, Julie. I had a question in regard to a change of career as you were describing it, Justin. So if you had a bunch of passive losses that can offset only passive income that you had carried forward, just for the sake of argument, for 10 years, and you became a real estate professional, can you now offset, can you bring those forward and offset all of your active income currently?
Potentially, yes. So passive losses build up and build up and build up until there's a point at which they are allowed to be released. And now whether that's offsetting other passive income, whether it's liquidating an investment, or whether it's introducing other active income that allows us to qualify as a real estate professional. There's various ways at which we can release portions or big chunks of those passive loss carry forwards, and that's one of them.
Hey, Justin, can he do the 5-year look back on that?
I would not recommend it.
Okay.
I would probably consider that aggressive. And I don't know if I would sign those returns. But the theory still holds, right? If we can show some sort of effort, even if we're not meeting the test completely, again, all of these things are dependent on, we got to prove it if we get audited. Most people don't get audited most years. But if the one time comes up that you do, we don't want to be the guy standing there going, oh crap, I really shouldn't have done that. I'm very sorry, and here's a gigantic check.
Well, thank you.
Yeah. Awesome.